Assalamualaikum. Bismillahirrahmanirrahim. Wassalatu wassalamu ala sayyidina Muhammadin asyrafil anbiya'i wal mursalin wa ala alihi wa sahbihi ajma'in. Rabbi israh li sadri wa yassir li amri wahlul 'uqdatam min lisani yafqahu qawli. Allahumma rabbi zidni 'ilma warzuqni fahma. So today I'm going to give you a lecture on this dividend policy. So this dividend policy is to teach you on the following, which is the importance of dividends, different types of dividends, dividend payment process, the theories of dividend policy, and what is the impact of giving stock dividends and stock splits or share split to this the balance sheet of the company. So the first part of the dividend policy will cover importance and different types and dividend payment process. The second part of the dividend policy will cover the theories and the impact of the stock dividends and stock splits. Okay, what is the dividend? So this is a portion of payment that company pays to its shareholders. For example, like here, so when company already pay for the income tax, pay for the interest, pay for the dividend for the preference shareholders, so whatever income left is called as the net income available to the ordinary shares. So the company can use that net income as paying dividend or retain for the business investments, retain profit for the business expansion. Okay. Or for the business investments. So for example, if the company retains 70% and 30% as a dividend distributions, this we call it as the dividend payout ratio. 30% out of the 100% of the net income available to the ordinary shareholders. So this is how much company pay out dividend relative to the net income. So that is the dividend payout ratio. So let's say the dividend paid in terms of the value is the 5 cents, RM 0.05 cents per share. So this we call it as the dividend per share, right? So for every unit of shares that shareholders hold, they are entitled to get the 5 cents per share. And the dividend yield is how much the company pay dividend relative to the stock price. So to calculate the dividend yield is dividing the dividend per share with the market price per share. So let's say the market price per share is 1.2 and dividend per share is 5 cents. So the dividend yield is 4.17%. So this is how much the company pay dividend in relative to the stock price. Okay, back to this. So this is the what is the dividend? So this is a payment or portion of payment. So as per example, 30%. So a dividend payout ratio is paid to the shareholders. So it's a portion of payment that the company pay to its shareholders. Also known as the distribution of assets. So distribution of asset means the cash flow if the business is paying cash dividend among the shareholders from the company's profit or net earnings. So why dividend is important? So dividends are important consideration when investing in the share market because dividend is one of the source of investment to the investors or source of income to the investors. So in market, so we know that there are two types of investors. One is the capital gain investors, another one is a dividend gain investors. So dividend gain investors. So dividend is important, especially for the dividend gain investors, which these types of investors are expecting the company to declare dividends as their source of income every year. So payment of dividend is much more depend than an increase in capital growth in a given year. So this is for the dividend gain investors. If another one is a capital gain investors. So the capital gain investors, they are much more hoping for the appreciation in the share price, in the market share price or market price per share, which is the capital growth. So they are more expecting on the capital growth that can increase the market price per share. Dividend gain investors is hoping for the increase in the dividend. So that means they are hoping for the dividend growth. Okay, so most companies in Malaysia pay dividend every 6 months or on a yearly basis. Some companies announce special dividends when they perform extremely well. So dividend is paid if it is paid earlier before company closing account. This is known as the interim dividend. Okay, known as the interim dividend. And if it is paid on a yearly basis after dividend is declared in the annual general meeting, so usually this is known as the final dividend. Okay, so sometimes the company may pay extra, which is known as special dividend. So we can see there are 3 types of dividend, which is the interim dividend, final dividend, and special dividend. Interim dividend pay earlier before the company close the accounts, before the annual general meeting announcement made on declaration of dividends. Your final dividend usually on the closing of the accounts and declared during the annual general meeting. And sometimes company may pay extra dividend, which is known as the special dividends. So we may take a look at the types of companies. So here, example. So you can see the example, Malaysian companies that pay dividend. So this is the highest dividend stock in Malaysia, paid by the company. I think this is last year, financial statement last year, declared in this year, 2023. Financial statement as 2023, but declared in 2024. All right. So 10 high dividend stocks in Malaysia 2023. So you can see that MBSP is the highest, 11.97%, followed by the RHB Bank, Maybank, Hapsang, ABNB, Axiata. Okay, so Sime Darby. So you can see that the banking sector, inclusive the MBSP, also is under the finance, banking and finance sector. Okay, is the top 3 company paying high dividends in Malaysia last year, as per financial statement last year. So which is the highest is leading by the MBSP, 11.97%. So Hapsang, I think this is a company, if not mistaken, is the maybe it's a in construction company. And next is Alliance Bank. Alliance Bank also is the banking and finance. Okay, Axiata is telecommunications. Heineken, this is food and beverage, liquor company. Genting and Sime Darby. So Sime Darby is the GLC company. Okay. So types of dividends, you have cash dividends, stocks, property, liquidating dividends. So cash dividends, so this is the normal or the usual dividends paid, okay? Usual dividends paid. So if dividends paid per share, for example, here is 5 cents, paid for every shares held by the shareholders. So usually this is known as the cash dividend. Cash dividend. So the company will prepare a cash voucher, or nowadays they will credit direct to the shareholders account. So cash dividends, so the company must make sure that they have a cash flow. So this will affect the cash flow. Cash flow is the assets of the company. Okay, so those paid out of firm's profit to the ordinary shareholders of the firm, stated as dividend per share or expressed as a dividend yield. Expressed as a dividend yield. So 5 cents, stated as a dividend per share. Okay, stock dividend. So this is also known as a bonus issue. Bonus issue. Instead of company is paying cash dividend, the company may pay or replace that cash dividend with a stock dividend. So this will increase the share capital of the company or equity of the company. Share capital of the company are representing by the shareholders. Number of units held by the shareholders will increase when the company give bonus issue or stock dividend. So this is issue shares to ordinary shareholders for free. Okay, so the implication will increase the share capital of the company and also increase the share capital holds by the ordinary shareholders. Okay, so this is a new issue of shares to existing shareholders as dividends. This reduces the value per share of the firm stocks. So while when company give the bonus issue or stock dividend, that will increase the share capital in units. So this will increase the base, means the number of shares, units of shares in the firm, and ultimately it will reduce the value per share of the firm's stock. Okay, so usually the stock dividend is paid based on the proportion basis. Maybe it is 1 for every 2 shares. Okay, 1 for every 2 shares, how about investors are getting 1 bonus issue, or 1 stock dividend, so 3 for every 4, or 2 for every 1. So it's given based on the proportion to the existing shareholders number of shares. Okay, property dividend, when a firm distributes property to shareholders instead of cash or stocks, and this property is valued at the market value on the declaration date. So property dividend so far in Malaysia is not, I've never heard implementation of the property dividend. Maybe this is overseas, US market or UK market, but in Malaysia it's rarely to have this property dividend, or I think there is none at all companies in Malaysia paying dividend in property. So usually company in Malaysia pay dividend either for cash dividend or stock dividend. Okay, liquidating dividends, this is especially when company in the process of winding up, company wants to go for the liquidations when the assets are disposed of, okay, and distributed among shareholders, and instead of giving cash surplus of assets, the company also may give them a dividend. So dividend paid based on the liquidation or winding up process, this is known as liquidating dividend. Okay, dividend per share, so this is the company's dividend return per ordinary shares. So usually calculated by shareholders to determine the amount of dividend income for every shares owned by the shareholders. So this is the we can say as the expected net income. Expected net income by the earned by the shareholders. Net income earned by the shareholders. So from this announcement of dividend per share, the shareholders can forecast or can expect, calculate how much the dividend income earned during the year. So dividend per share is the total amount of all ordinary dividends declared divided by number of ordinary shares outstanding. Dividend per share also can be further extended to the dividend payout ratio. So dividend payout ratio is the percentage. Usually DPR is in the form of percentage company's net income to the earnings per share. Dividends. So if follow to this, how much company pay out dividend relative to the net income. So retained profit represents the net income or represents the earnings per share. Earnings per share is the total earnings. Total earnings is the total retained profit over number of shares. So dividend is the dividend per share. So which is the dividend? How much is the dividend paid? Dividend declared divided by the number of shares. So from this dividend, we can calculate the dividend payout ratio. So the calculation of the dividend payout ratio is actually calculation dividend payout ratio is okay. So to calculate dividend payout ratio, that is the dividend per share divided by earnings per share, or dividends declared divided by total earnings. So that is the dividend payout ratio, dividend per share, earnings per share, or total dividends declared divided by the total earnings. So it is percentage of how much dividend payout given to the shareholders in relative to the income earned by the company. So any money not paid out in the dividend is usually used to pay down debt or reinvest in the key operations for business expansion. So here, what does it mean is, so any money which is not paid out as a dividend is known as the retained profit, and retained profit is used for business expansion, or it can use for pay debt. It can use for acquisitions, mergers and acquisitions, okay? Mergers and acquisitions, mergers and acquisitions, or also it can use for share repurchase, share repurchase. So this is the alternative that can be what the business can do with the retained profit available. Okay, so next is the dividend yields. Okay, dividend yields is the relative of how much company pay dividend. How much company pay dividend relative to the share price. So dividend yield is also the annual dividend payment made to stockholders expressed as a percentage to the stock's current price. How much that the company pay dividends as annual dividends paid per share compared to the current market price per share. So this tells the how much the future income the investor can expect from a stock based on the price that the investors are paying today. So that is the dividend yield. Okay, next is the dividend payment process. So you need to observe the dates for the dividend payment. Start with the declaration date. Usually it is announced at the AGM. So board of directors will announce intention to pay dividends at the AGM. The board will also announce the date of record and a payment date. So this is known as the declaration date. And the next is the in-dividend date. So in-dividend date contra to the ex-dividend date. So in-dividend date means inclusive or come dividend date, dividend date, or inclusive dividend date. That means if you buy shares before in-dividend dates, then you are entitled to have dividend. The last day before the ex-dividend date. On this day, the buyers will receive the dividends, whereas the seller will lose their right to the dividend. So buyer buy before in dividend, buyer buy before in dividend, then they will get the dividend. When buyer buy before in dividend, they will get the dividend. If the seller sell before in dividend, they lose the rights to the dividend. Okay, ex-dividend, if the buyer buy after ex-dividend, buyer buy after ex-dividend, they lose the right of dividend. If the seller sell after ex-dividend, they get the dividend or entitled dividend. Okay, in dividend means buyer, okay, buy before. Buyer buy before. Okay, so buyer buy before in dividend. So we'll get dividend. Seller buy, not buy. Seller is sell before. Sell first. Sell before in dividend. So not getting dividend, not entitled. Ex-dividend, buyer buy after X. The name is X. X means no longer entitled for dividend. But seller sell after X dividend, get dividend. Okay, entitled for the dividend. So in dividend is the last day before the X dividend. So X dividend, shares bought or buy and sold no longer come attached with the right to be paid the most recently declared dividend. So usually 2 working days before the record date or entitlement date. 2 working days excluding excluding public holiday, okay, excluding public holiday and excluding weekends. So let's say the number of working days for a company is 5 working days, which is from Monday to Friday. Saturday, Sunday is the weekend. And then let's say in the week there's a public holiday. So public holiday weekend cannot be included in the computation of 2 working days before the record or entitlement dates. Okay, date of record is the dividends payable to the shareholders whose names appear in the register of members as on the record date. So payment date usually is the entitlement date, when the company actually mails out the checks or credited to the accounts of shareholders. Okay, procedure for cash dividend payment. So let's say 15 January is the declaration date. So this is when the company have its AGM, annual general meeting, and declare dividend on this date. So next, let's say 27 January is usually the company will not declare the dividend date. So usually company will only mention on the X dividend date. Okay, let us look at the example here. So if you look at this okay. Okay, let's say we are looking at this. So this is the dividend, which is you can see there's announcement date. So where it is where the company have annual general meeting, make an announcement. Oh, yesterday, 28th of February 2024. So you can see that at Genta Legenda TH Plant, KGB is announced its dividend in the AGM, and there is the X date, entitlement date, payment date, how much dividend paid, and what is the dividend yield. The dividend yield, the information. Okay, so entitlement date, X date, payment date. So usually this X date is 2 days, as mentioned here. 2 working days before the entitlement date, before the entitlement date, not before the payment date, right? So not before the payment date. So looking at this, you can see this. So this is the entitlement date. So this the X date, 2 working days before the entitlement date. So you can see this is the practice. Tapi practice is 1 day actually, but looking at our notes 2 days, but mostly company in practice they are doing 1 day from the entitlement date. So you can see 14, 13, 21, 20, 13, 10. So this one is about 22 days. Maybe there is a public holiday here. Okay, 30th, 29, 35, 24. So 1 day. So this is a practice. But here our notes mention about 2 working days. So you just follow notes, just follow slides, because this is in general. So in Malaysia, is applying 1 day. Maybe in other countries, it's applying 2 days. Okay, so bear in mind that these 2 working days is calculated before the entitlement date. So looking at this example, if the record date is also the entitlement date, entitlement date, record date. So record date, dividend is payable to shareholders whose name appear in the register of members. Register of members is a list of the names of the shareholders who are entitled for the dividends. Okay, so here before the record or entitlement dates. So 30th June means 2 days before. 2 days before is X date will be 28 June. So entitlement date or record date is 30th. 2 days before working days. is 28. If between these dates there is a public holiday or there is a weekend, Saturday, Sunday, you need to exclude that. So it can be the X date. So this is in case there is a public holidays, one day, and there's a weekend, Saturday, Sunday, 2 days. That means the X dividend date will be not 28. So let's say I give you example. One day is the public holiday, and 2 days, 2 days is the weekends. Okay, Saturday, Sunday. So 30th January 28. So this is 2 days. 28, not 27, 3 days. So that means 26 January. 26 January will be the X date. Okay, 26, let's say 27 is public, 27, 28, 29 is weekend. So 29 and 30. 29 and 30. So let's say one day here is considered as 27. 2 days here, 28, 29. Okay, 27, 28, 29. So that means 30th June and 26 January. 28, 9 and 30. So 26, I think is 25 kat sini, so not 26, sorry, 25, the X date. So 25, 26, 1, 26 January. Okay, so 1, 26 January is 1. Then 30th January is the second day. So this is the first day, this is second day. So 26, 20 and 30th June. Kalau here 29 dengan 30th June. So 25th, this is the last X date. X date 25th. So that means 24 will be the in date or come date. In date or come date. So this is in case when there is a public holiday and weekend. Let's say public holiday on 27. So 27, 28, 29 is a weekend. So 30th June is an entitlement. So you calculate backward. 30th is the second, hari kedua, second day. So that means first day, because it must be 2 working days before. So 29, 28 is the weekend, 27 is the public, 26 first day, and 25th January is the X date. 24th is the come date. Okay, understand? So come date is one trading day before the ex-dividend date is entitled dividend for both existing shareholders and buyers. Ex-dividend trade on or after ex-dividend not entitled for the dividend. Seller or existing shareholder will receive because sell the shares after ex-dividend date. Record date. So this is the date when the company have the list of its shareholders in the register of members. Payment is when the dividend is credited to the accounts of the shareholders. Okay, so this is known as the dividend policy, dividend payment. So we call it as the dividend policy, which refers to the practice used by the management whether they want to decide to pay dividend or not to pay dividend, how much dividend they want to pay, and how frequent they want to pay to their shareholders. So the types of dividends, how much dividends they want to pay, and how frequent they want to pay. How frequent means, is it they want to pay 2 times a year, which is interim and final, or only once a year, yearly basis, which is a final dividend. Okay, as well as is there any special dividends? So this is known as the dividend policy. So dividend policy is important because that can attract the dividend gain investors. Okay, and it can create the investors' confidence on the company performance. Okay, next is the importance of dividend policy. Number one, dividend policy has close relationship with the financing decision, because dividend decision, as I mentioned, affect cash flow. So to pay dividend, the company must have money. So that money is the cash flow. And if the business do not have enough cash, so that will affect the financing decisions. So where to get the source of cash? So that comes the financing decisions. So this is the strategy in regard to the amount they pay to their shareholders as dividends. So they need to decide how much dividend payout ratio or portion of earnings to be paid to the shareholders in the form of dividend, and how much to be retained in the business. So company actually has three options, which is number one, whether company may retain all the profits within a firm, means there's no dividend declared at all, or company can share the dividend with the shareholders at all, means distribute all the profits in the forms of dividends, or the company may partly retain the profits for business expansion, or partly distributes the profit as a dividend to the shareholders. So usually the third option is the most popular implemented by the company. Okay, usually this involves the trade-off between dividend and retained earnings, or trade-off between the dividend decisions versus financing decisions. Okay, there seems to be an inverse relationship. Inverse means trade-off between retained earnings and dividends. When company pay higher dividends, for example 70%, it left little for retained earnings. If company pay little for dividends, it left more for the retained earnings. So higher dividends, so this one is 30%, so this one is 70%. So higher dividends lead to the little amount left for the retained earnings. So that will lead to the external funding. External funding, for example, like issuings of bonds or debentures, or have a bank loan, which involve cost of borrowings. So decisions to pay large dividend would mean little amount for retained earnings for funding the growth. Therefore, the firm will rely on the external funding for its investment. And oppositely, when company pay little dividend, for example 30% as compared to the 70%, so this would lead to the higher profit retention and less relying on the external generated funds to finance for the firm's investment in the future. But the impact or the effect of this decision policy will make the capital dividend gain investors or shareholders unhappy, especially those dividend gain investors who are expecting dividend as their current income. So there are four types of dividend policy, which is the regular dividend policy, irregular dividend policy, no dividend policy at all, and residual dividend policy. So regular dividend policy means the company always pay dividend, consistent, predictable basis. So usually there is a growth in the dividend payment. There is a dividend growth in that dividend payment, consistent and predictable basis. If the company is paying in a consistent and constant rate, that we call it as the dividend constant growth. Okay, so if company is paying increasing rate of dividend, that we call it as the dividend differential growth rate. So the goal of the policy is to provide consistent, substantial dividend stream. Besides to allow the company retain sufficient liquidity to capitalize any future investment. So besides, we want to make both parties, which is the shareholders as well as the company, in a win-win situation. The shareholders are happy with the dividend declaration. At the same time, the company have sufficient internal fund to cover its future investment opportunity. A company with a consistent cash flow, good liquidity, stable earnings is the indicator of the high confidence level and best suited for a regular dividend policy. So 3 ways to implement the regular dividend policy, which is a constant dividend per share. So this will contribute to the constant growth rate, constant dividend growth rate. Okay, constant dividend per share, constant payout ratios, this one also, right? And stable dollar amount of dividend plus extra dividend. So this one considered as the differential growth, dividend growth. Means that the company may not have a constant dividend per share or constant payout ratio, but the company will have a different rates. For example, year 1, maybe the company is paying 1%. Year 2, maybe it's 1.5%. Year 3, maybe the company is paying 2%. So it's a growth. There's a growth in the dividend payment. So irregular dividend policy, the company may not pay dividend or may pay the dividend for a variety of reasons. If the company do not have enough cash, maybe in that year, company will not pay the dividend. So the reasons could be due to the lack of liquidity, volatility, or instability in future earnings. So let's say, based on forecasting, the future earnings of the company will be affected due to the economic recessions or due to the changes in the policy, government policy, or any circumstances happen in the world economic, for example, the world oil price, that can affect the future earnings of the business, the company may decide not to pay dividends. Okay, so if the company is not consistent in paying dividend, so this is the irregular dividend policy. Investors in these companies never know whether or not they will receive a dividend during the year. And if the company is paying, they do not know how much the company will pay because it is uncertain. You cannot predict. So irregular dividends is most common in businesses when the business have erratic demand for their products and services. Means when the product and services of the business is very uncertain or very vulnerable to the changes in the economic world, to the changes in the policy, or to very susceptible to the problems happens. So that's why it is not easy to predict, or the dividend is very uncertain for this type of company. So the unpredictability in business make it impossible for company management to commit a regular dividend policy or stable dividend policy. Okay, no dividend policy means not paying dividends at all. This is especially if the company wants to retain its profit, want to keep their profit for reinvestment. So this one, especially for the growth companies, company in the growth stage companies. So they are focusing more on investment to increase the company growth rather than to share their profit with the shareholders. So this usually preferred by the capital gain investors. Because capital gain investors hoping that by retain the profit and focusing on investment, the company growth will increase. That will increase or appreciate the share price, the value of the firm. The value of the firm increase, that increase the share price of the firm. Then the appreciation in the share price will give a capital gain to the investors. So all profits retained invested into business to fund growth opportunities. So companies without a dividend policy tend to grow and expand at a rapid rate, and the value of their stock is likely to appreciate significantly. So this one, appreciation in the market price per share. So these usually attract the capital gain investors because they perceive that the value of firm, the value of shares is more important rather than paying dividends. Residual dividend policy. So this is influenced by the firm's investments in the firm's investment in the future. So if the business, if the firms prefer to keep their retained earnings for future investments, that means whatever left after they put aside that retained profit for firm's investment in the future will be used to pay for the dividend. So residual means whatever balance left. Okay, balance left after profit is retained for investment. Okay, retained for future investment is put aside. Okay, then whatever balance left will be paid as a dividend. So this is known as the residual dividend policy. So this policy is heavily influenced by the firm's investment in the future, firm's investment opportunities. So this is quite similar with the no dividend policy, where it is focused more on investment. But the difference is no dividend policy, they don't have policy to declare dividend at all. But here they have some profit. They have some profit to be shared with the shareholder as a dividend payment. But the number of dividend per share or dividend yield, this depends on the how much they keep the retained profit for future investment. So that's why it's heavily influenced by the firm's investment opportunity, because they are focusing more on the funds available for financing new investment. So the dividend only be paid when all financing has been put aside for the positive net present value investment. So assuming the flotation cost to raise the external sources is very expensive. So that means they want to use more or relying more on internal fund. Internal fund means their retained earnings, their retained profit or their retained earnings. So because they assume that if using the external fund issue of new shares that involve high flotation costs, or maybe by having debentures or issuance of bonds, issuance of debentures, or having the loan bank, so that will involve the high cost of borrowings or high cost of servicing the debts. So it's better to have the internal fund by put aside some of their retained earnings, if that is more economical for their business or for their firm. So once the firm has raised sufficient funds for this project, then the balance left will be given to the investors. So this is known as a residual or leftover or balance. So due to that, investor doesn't know how much the company will pay their dividend. So from the company's perspective, this policy significantly reduced the need for external funding. So this is, we can say, as a win-win situation. Okay, so the dividend policy theories I will cover in the next videos, in the dividend policy video 2. So with that, thank you very much for listening to this video.